Okay, let me now bring on board Naren from ICICI Prudential Asset Management to talk about where they feel markets are headed, why this year could be a different year, and how this year will be a different year from 2021. Naren, welcome back. Thank you for joining us. Hope you're feeling better and you've recovered completely and fully.
Yes, wishing all the viewers a very happy, healthy, prosperous 2022. And hope Omicron goes away in the next 15 days to 30 days.
Well, we all are hoping that, and we all are praying for that. So, Naren, what is the lay of the land? How do you think 2022 is different in terms of macro valuations and in terms of the levels of foreign retail investor?
See, in March 2020, we realized that the central banks backstopped the market and created one of the biggest bull markets ever. And now they have to do the job of trying to dampen inflation. So I think 2022 promises to be a volatile year, and basically the central banks cannot pump in money the way they did in 2020 and 2021. So the key still rests with the global central banks and not with anyone in India. So if they decide that they are going to remove the money from the markets, or they are going to increase interest rates and they are going to take away the QE, they're going to do negative QE, I think that we are going to head for a period of volatility. On the other hand, if they again decide that we are going to do QE, it's going to be very supportive for equity markets. So I think we have to recognize the fact that we are in a global central bank bull market, and eventually that is going to play a role. In India, what is different is that we have a massive retail equity bull market also. And that massive retail equity bull market remains unlike in many other parts of the world. So it's very important that the retail equity bull market investors recognize the risk that they are taking, and they remain conscious of the fundamentals of the stocks that they are buying. Otherwise, they will lose money and then blame everybody around them. And that is a risk. And India is one of the few countries in the world where the retail bull market is in full frenzy. If you look at US, for example, more than 50% of the loss-making companies are down 50%. So the retail bull market in US is coming down. So India is one of the few places where the retail bull market is in full frenzy. And therefore, it is important for the retail investors to focus on good quality stocks, use fundamentals to buy them, and not get too caught up in speculation. This is the request that I have for all the retail investors, because fundamentally things are not a problem. But if they buy loss-making stocks like what happened in America and then they lose 50%, then they'll blame the system, and that is not correct.
But some would argue, Naren, that the retail investors of 2020 of this bull market are far more, far more aware, far more aware in terms of risk and asset allocation. And what we are seeing is just a shift which has been long overdue.
No, information is like, having been in markets for 32 years, information is much more democratized, and there is a lot of information available thanks to channels like yours and various other ways. But that does not make investing easy. Investing is not arithmetic. Investing is much more complex than all that. So yes, information is available, data is available, lot of things are available, including annual reports and so much of other data. That does not mean that people don't get caught in speculative excesses. And this is something which we have seen even in US, that the most sophisticated market in the world also goes through speculative excesses despite so much of illiteracy and so much of knowledge and so much of capability. So I think My reading is that it is important that people practice asset allocation, people practice logic, people practice discipline. And there is no problem with the markets, but it is still important for people to practice all these things because even in a sophisticated market like US, look at the number of stocks which have fallen 50% in the last 4-5 months. And you can see some of the IPOs, they go up 100% and they fall 50% in no time. So I think information does not mean that you have got everything right. And it is in fact very complicated that you have too much information these days.
So Naren, what we can do is perhaps divide the market in three components. The starting point for valuations based on price to book, P or market cap to GDP. The scope of earnings and projections in terms of where FY23 and FY24 are headed, and the duration in terms of the time which needs to be understood. So let's start dividing the market in three parts and we'll address all of them one by one. So first, valuations based on price to book or market cap to GDP or even PE, all metrics which you use. What is the starting point for this year?
See, basically, you look at areas like banks, you look at areas like auto, you look at areas like PSUs. All these areas are not worrying in any way. They have gone through fairly sideways movement for years. And there isn't much to worry about. And I would say that these are all areas, if you take a long-term view from here for 3 to 5 years, I don't see any problem. Even the capital goods cycle hasn't done well, but there aren't too many stocks now left. But I would say these are all areas where I would say no problem. If I look at some of the consumer quality names, the quality names are trading at high valuations. They are all quality names. So they may not deliver returns for a few years or so, but eventually they are quality names. So I don't think they go down significantly over the next 5 years or something like that. They may go through a period of sideways movement for quite some time. As it is, they have gone through sideways movement for the last 18 months. Maybe for some more time, they'll go through sideways movement and they'll continue. So if you look at some of the IPO stocks which have got listed and then the stocks have just zoomed, I think those stocks you have to be much more careful about because you don't know the corporate governance history of some of those managements. We have to think what they are, etc., etc. So I would say that those are all areas that you have to worry about. Sectors like IT are growth sectors. We have debates in our company. Some of the growth-oriented fund managers in my colleagues, they're very happy because these are the sectors which are doing very well on the growth front. So maybe from my value school, I find them a bit overvalued, but the growth-oriented fund managers find them comfortable because they're doing exceptionally well. Look at sectors like pharma and all, they also look pretty reasonable with a long-term view at this point of time. So I would say that overall, there isn't much scope for worry, except that, periodically you have all these loss-making companies doing IPOs based on some 2027 earnings, and then they go up substantially and people think that they should be looked at. And those kind of areas that's why I said that it's more important for the investor to be disciplined. I don't think the market is in that dangerous shape as individual stocks are at this point of time. Because if you look at it, market, yes, they have gone up from 2020, but there was a period before that where the market was stuck for quite some time. So that's why people, yes, on market cap to GDP, things are high, but then a lot of new companies have got added. And that is the reason market cap to GDP is high. And India structurally, if you look at from a business cycle point of view, we are not in 2018. There are no NBFC related issues. There are no NPL related issues. The top corporates have deleveraged. The problems are only in the I would say that it's only at the bottom of the pyramid that we need to see more incomes. The IT sector doing well means that a lot of jobs get created, so incomes improve. Job market is in much better shape than 3 years back and 4 years back. So in all those kind of things, things are definitely better. So I would say the problem right now is more investor exuberance than economy exuberance or anything of that kind. And that's where we are different from 2018, where there were serious concerns on economy, whereas now there are no serious concerns on economy at this point of time. Of course, oil is going up, and that is a negative. There are risks on the US business cycle that can create a problem for this year. But that is not going to create a problem for the next 5 years for India. That will create a problem for this year maybe. And that's why you have to be much more careful as an investor than anything else.
Why does your year notebooks indicates that equity will do well in the long term, but we remain cautious over the medium term? Is it only a indicator which you are basing on sentiment? Because if you are reasonably confident about the balance sheet of India, the corporate profitability, large sectors like banks, if they are cheap, why does the ICICI Prudential Asset Management yearbook says equities may do well over the long term, but we remain cautious in the medium term?
See, the problem is what our years of looking at markets says that the global trend is more important than the local trend. Take, for example, the last 1 month. US yields went up, Indian yields went up. Now, Indian yields have already touched 6.5%, which is very high. Because the global yields have gone up, Indian yields have gone up. So somewhere the global trend is sometimes much more important than the Indian trend we've seen. Globally, particularly US markets have gone through a bull market from 2012. So we clearly feel that there is a potential clear medium-term worry which will happen when the US central bank raises rates and removes QE, maybe does negative QE, etc., which can create 2 years of volatility. So that is the reason why we are more worried, and we have never seen, people keep saying that India will diverge from the West and things like that. But we have hardly seen that happen. So that is the problem that we see, that we want Indian yields to stay static when US yields go up. It doesn't happen. Indian yields have shot up along with the US yields. Although Indian yields are at 6.52, we have never seen QE on the scale of US. But despite that, Indian yields are shooting up, and that will have a big negative impact on Indian economy if the Indian yields keep going up like this. So that's why what we believe is global markets are very important for Indian markets, and that is the reason why we believe that the long term looks good, the medium term is hurt by what will happen by global central banks, and the $25,000 billion of money that has been pumped in is going to have some impact, because at some point of time they will have to pull out some of this money. And that is very clear at this point of time. And that is the reason we have this view. Having said that, Indian long-term structural story is certainly intact, and I don't think that is a problem. But how the India behaves, how it decouples from the West, that is something which we are going to see. How it happens is something going to be very interesting for us at ICICI Prudential. We'll watch and communicate. If we really see that the decoupling happens very smoothly, we'll communicate it at that point of time. But right now, we have never seen it decouple. We have not seen it decouple in 2008. We didn't see it happen in 2011. We didn't see it happen in 2015. So why should we assume that it will decouple when US increases yields this year?
So Naren, the fact that interest rates will go higher is almost like given this year. The fact that liquidity will be impacted is almost like given this year. How much of this liquidity reversal or interest rate tightening is something which markets are already pricing in? And when the actual interest rate cycle will start, what happens to the market that time?
I mean, it's a question which we find very interesting at this point of time, because end of the day, so far there are times when the first rate hike can could be the time when the market bottoms out also. So that could happen also. But what we believe is that what has actually happened in the West is they keep talking. But QE continues. Even today, there is QE happening. So after watching 2018, what we realized is that we have to see whether QE continues or QE becomes negative. So what the central banks do is more important than what they say they will do. So I think right now they are keeping on saying, particularly the US, the global central banks. Let's see whether they actually do. If they do, I think the impact is going to be there. And this was the learning in 2018. People see 2018 Indian market correction as a local correction, but it was actually a global correction. The day Fed Powell in December said, I am stopping QE stoppage and I'm going to again start QE. Then after that, all the markets started to recover. So I believe that it's important to watch what US Fed does rather than what they say they will do. Right now, there is still QE continuing. It is just that taper has started, but it is not that QE is not continuing. So I think it's going to be interesting. And it's whether they'll do negative QE like what Fed Bullard said yesterday. Are they going to increase rates? Are they not going to increase rates? These are all going to be interesting things. And the world has become used to zero interest rates and QE. And we saw that in 2018 when the world saw negative interest rates positive, there was an impact. So that's why I don't think it's easy for us to say everything will decouple, India will go up continuously. All those things it's too early right now for us to say. Maybe we'll say it 6 months later, but we can't say it today. It's not correct at this point of time with this kind of valuation. It is much better to say asset allocation, much better to say be a bit more careful than to say that just be very, very positive like 2020 or even early 2021.
Okay. So, Naren, if you feel that the US business cycle is at a risk, can I say that it is time to focus on inward looking sectors? Because if the trade last year was to, let's say, buy metals, IT, this year the trade could be banks, domestic autos, infra, road companies.
In my opinion, it should be a part of it should be trading also this year, because at the end of the day, the markets are at a different level from where we were last year. And that's why asset allocation and active management are two of our most important frameworks at this point of time, because markets are not at 2020 March or 2021 level. So I think asset allocation and active management has to be an integral part of 2020 way of investing. And this would be maybe across asset classes, not just equity, maybe even in debt. Because at the end of the day, we are in a situation where if you're made money, you have to book some profits. And that's how we look at it, even in the sectors which are cheap, like banking, auto, infra, as you mentioned.
Naren, you have a very deep understanding of metals, and you've always bought metals when there is pain on the street, when metal cycles are reversing. But looks like metals are in a sweet spot. We spoke to the management of Tata Steel a few days ago, and they feel that the steel cycle is a multi-year cycle. I'm sure you must be getting the same feelers when you speak to other companies also. So how does one approach a sector like metal, where prices have come down, but they are not exactly cheap, but the cycle in front of us looks promising?
At ICICI Prudential, it becomes easy because we bought it very cheap and we hold on to our old positions. So it becomes very easy. For people who have to take the call today, it becomes much more complex. But having said that, where is the new supply in aluminium? Where is the new supply in zinc? Where is the new supply in copper? At least in steel, there is some new supply. Some of the problems in metals is that to understand what China is doing in policy becomes very complicated at some points of time. At times, their policy is so complex that there are corrections which happen in a big way because of China policy, and that gives you room to buy at different points of time. So what we actually tell people is if China policy results in a big correction, that possibly is a good time to add to metals. And similarly, if China policy seems to result in a very big rally, that may be a time to trim metals. That's what it looks like because no one can understand China policy. And we have spent we have spent at ICICI Prudential so many years trying to understand China policy and metals, and we have not managed it. So, but whenever China policy seems to create big bull market in metals, sell. If they cause big bear market in metals, buy. And at that point of time, it's always very difficult.
Then you're a true blue value investor, which is that you like to buy stocks which are cheap, based on assets, based on price to book, based on P multiple. The proposition for a true blue value investor in 2021 was value stocks are cheap, they've had years of underperformance and economy has come back. But value stocks have also come back, whether it is State Bank of India or metal stocks or utilities. How would you identify value in this market? And for those old value stocks, what is the pitch now?
Actually, no, always something becomes value. That is the beauty. So if you look at auto has done so badly now for years. Some of the private banks have started to underperform now for years. So yeah, I mean, so you'll always find that some of the PSUs have still not delivered, if you ask me. So it's not as if it's so difficult at this point of time. Whereas, I mean, a sector like tech has clearly gone out of value territory for a person like me. Whereas my colleagues who are more growth oriented, they find it very attractive. So I would say that at all points of time, there will be something which is attractive on the value space and something which is unattractive. So we have never seen that problem. It's interesting that in 1999, old economy was value. In 2007, FMCG, pharma, technology was value. So at various points of time, different sectors become value and give you scope, because at all points of time when you're buying them today, for example, look at auto, take two-wheeler as an industry, for example. Two-wheeler as an industry is today deep value at this point of time. Look at the last 3 to 5 year returns of two-wheeler industry. They've done exceptionally badly. And so like that, I mean, even if you look at car industry has done badly for years now. So I would say that different sectors become value after underperformance, whereas 3 years back, auto would never have fit that bill, but now it does. So I think that is never a problem. It is just that gathering the emotional strength to buy a sector which has done so badly like two-wheeler, it's not easy. That's all I would say.
Naren, since we've spent a considerable amount of time and trying to understand EV as a disruption, do you think this entire EV as a theme is slightly overdone? Yes, EVs are here. Yes, EVs will be disruptive. The mode of transport is changing, but the way some of the EV related stocks, whether it is Tata Motors or for that matter some of the EV ancillary stocks, globally a name like Tesla, the way the EV cycle chain and the entire the entire supply chain has got re-rated, there is a bit of a euphoria there.
It's easy to say that, but just imagine if you're a global fund manager and you're underweight Tesla, what would you say? So I think, I mean, disruptions are something which sometimes you realize later. Who would have imagined that the entire advertising industry will be taken away from print media significantly to the internet world? So I think one of the lessons we as fund managers have learned over a period of time is never disregard disruption. be always conscious about it. As at ICICI Prudential, we are working continuously the kind of work that on a regular basis we are looking at EV and all of them is continuous, because at the end of the day, we don't know whether the incumbents are doing enough work, whether the disruptors are going to take over from the incumbents or not. We have to be conscious about it. And we have to engage with companies on conference calls and try to ensure that they also don't miss disruption, because if you miss disruption and you get caught, you may become obsolete. And that is also the duty of a large institution like ICICI Prudential. So that's how we look at it. So continuously we are engaged in that work, and it's very interesting. Some of the areas of disruption, how they play out, will be always very interesting. Whether it is e-commerce, whether it is EV, whether it is any of these areas, whether it's fintech, all these areas become very interesting to look at.
Are banks cheap for a reason? And we can argue some of those reasons, that credit cycle is different, fintech is the reality, or you think the underperformance in banks is a opportunity? I'll just ask this for the benefit of our viewers once again. Are banks cheap for a reason, Naren?
I mean, our view is that it is only because of ownership where this problem has come, that it is owned by everybody. So the last 3 months when FIs needed to sell, they just sold banks. And it is the most liquid sector and easy sector for any FI to sell. So I think it had less to do with fundamentals and more to do with the liquidity of the sector. I don't think I think the Indian financial system is more efficient thanks to all the work done on the payment side and various work done on the internet side, that we have a more efficient banking system in some of the ways. See, people talk of fintechs in other parts of the world, but in other parts of the world, payments and various other things are so costly that fintechs can easily disrupt. In India, many of the things we get free as customers. So that's why I think the Indian banks are pretty efficient at this point of time. And that's why I think it's more a function of ownership of the sector being so widespread in the institutional community that the sector did so badly in the current year. And the second problem is that credit growth hasn't picked up. And I believe that over the next 2 to 3 years, credit growth will also pick up. And that will be the second thing which should help, because the NPL issue is clearly behind us at this point of time.
So Naren, final question. And the image of S. Naren is that he's conservative, he likes to buy value stocks, he likes to always look at things based on historical averages, buy the stocks when they're cheap. But some of the new businesses don't have a historical benchmark. In fact, they don't have a benchmark. Now, whether it is an e-commerce company, whether it is a platform company, or whether it is a logistics company, how are you making sure that your investors participate and benefit in this new e-commerce stroke the new digital world? How will you ensure that? How will you make sure that S. Naren is not about steel, metal and value, he also understands growth? It's not a good image to have, Naren. I'm sure you're changing that image.
To look at the weighted average age of the analysts in my company, it is very low. And all the new age stocks are looked at by them and not by people like me. So most of the fund managers are also much younger than me. So I would say that, if you look at, we participated in many of the new age IPOs also, and didn't participate in one or two which have done very badly. So I would say that credit goes to many of my younger colleagues in the team who I think are better equipped to look at these new age trends than me. So maybe I'm not fully hands-on in many of these stocks, but my colleagues do all that work. And that's how we have avoided some of these stocks and taken decisions in some of these stocks. And that's why that's how we look at it. And instead, what I do is I enjoy looking at asset allocation and those kind of things. And that's how we, as you know, we have launched this fund called multi-asset passive fund of fund, which I think is a very interesting structural trend of combining both passive and asset allocation at this point of time, which is something which is closer to my heart. And I leave many of these new age stocks to be looked at by my younger colleagues who have done a very good job of avoiding some of them and investing in some of them.
Well, Naren, really appreciate your time. That's what teams are all about. You look at a few things and then hire expertise in what you don't understand and what is new. So really appreciate your time. Thank you for joining us. Always, enjoy interacting with you. Yes, it's going to be a different year. It's going to be a year when active management will make a comeback, but the India story is alive and kicking, both in terms of the balance sheet, earnings, and also where we are headed in terms of an economy. So appreciate your time, Naren, and have a wonderful year ahead.
Thank you. Same to all your viewers. Thank you. And you.